These are some of the most common messages I've seen on the channel. You shouldn't buy real estate. There's a market correction coming. Prices are gonna go down. I don't wanna buy a house now because I don't wanna overpay. I know a market correction is coming and I don't wanna lose money paying more for a house that might not be worth it in the future. Today, I'm here to show you that no matter what happens in the economy or whether housing prices go up and down, if you were to take action today and buy your property today, you will always come out as a winner and you will never ever lose money. Let me show you. Let's suppose you're about to buy a $400,000 house with a down payment of a 20% and your mortgage interest rate is sitting at 6.81%. And you're using a 30-year mortgage. When you do the math, you will find out that at the end of the 30 years, your house will end up costing you $831,785.34. What? $431,785.34 in interest? Welcome to Nova Rice, your channel for financial education. In here, we talk about investments in real estate, investments in the stock market, in precious metals, and small businesses. I know that the interest can be a little scary, but I want to invite you to focus on something else. You see, real estate has historically gone up an average of 5%. I know that there are some years that the market is not doing so good and then real estate prices fall. Some years they do go up, some years they go up by a lot, and some not so much. That's why it's called an average. So you take the average of all the historical prices, and that's how I landed at that 5% increase every year. So take into account that information. If you were to plug in that increase to your purchase of a $400,000 house with an annual increase of 5% every year until the end of that 30 years, that means that the value of that same house at the end of the 30 years, it's going to be approximately $1,728,776.95. So if you were to compare the numbers side by side, you would take the future value of that house with a 5% annual increase. Your house will be worth at the end of the 30 years, a total of $1,728,776.95. You take that number and then you're going to minus it to the amount that you pay, which is $831,785.34, and that will leave you with a difference of $896,990.07. That's the total that you're getting in savings because the market appreciation alone is taking care of your property. So even though you're getting a loan and you're paying interest on that money that you borrow, you're still saving money because you're taking action today. Yeah, but what about the associated costs of buying a house, like property insurance and property taxes? Valid point, but we're going to get to that in a minute. I want to talk about something else before we get to that. And that's the concept of depreciation. Did you know that the IRS allows you to depreciate your house and deduct that cost from your taxes, saving you money in the long run? I mean, that's additional money that you're putting back into your pocket. The IRS is not necessarily giving you a check and say, hey, take my money. What they're doing is they're taking a certain amount every year and they're going to deduct it from your taxes. So that means you're actually saving from having to pay that money in taxes. So in a way, it translates to more savings to you. Let's take a look at this example. So let's say you buy that house for $400,000 and the IRS for residential properties will allow you to deduct the cost of that house over 27.5 years. If you're buying a commercial property, that would be 39 years, but we're going to use a residential property in this example. So when you take that $400,000 and then you divide it by 27.5, that means you'll get to deduct $14,545.45 every year from your taxes. But since this example is making a reference to a 30-year mortgage, that means that by the end of the 30 years, you have depreciated the entire house because 30 years is more than 27.5, which means that in a way, you never pay for the house. Let's go back to the original table again. So when you look at these numbers, you will realize that the down payment and the loan that you got, they both sum up to $400,000. But since you held the property for 30 years and you enjoy depreciation expense, you can actually cross that $400,000 out of your expense. And in reality, the only thing that you pay was interest. So a better way to look at this is to take the future value of that property in 30 years, that $1,728,776.95, and then you're going to minus what you pay in interest, $431,785.34, and that will leave you with $1,296,991.61 in savings. These are the real numbers. When you educate yourself and you strategize and you understand about the tax code, everything adds up and every little bit of information can be translated into additional savings for you. What do you think about this so far? Let me know down in the comment section below. Now, let's get back to the question about property taxes and insurance. So, according to my research, property insurance has gone up an average of 10.4%. Remember, this is an average. I am aware that some areas are more expensive than others and vice versa. Some areas are more affordable than others. So let's keep things into perspective and let's focus on the fact that this 10.4% is an average. Now, the same applies for property taxes. Based on my research, they have gone up an average of 10.4% nationwide. And once again, this is an average. This is an average because not all areas are equal. And if we were to consider every neighborhood in this country, we're going to be here a long time. Now, let's look at this mortgage calculator. According to Zillow, if you were to buy a house of $400,000, the property taxes and the cost of insurance on a monthly basis will be $300 a month for taxes and $79 a month for insurance. So to get an annualized number, let's multiply this number by 12. And that means that the cost of insurance will be $3,600 annually. And if we were to consider the increase of 10.4% on that insurance every year for the next 30 years, you would have ended up paying $708,935.06. Now, onto insurance, we saw that on a monthly basis, it will cost you $79 a month for a property worth $400,000. So when you multiply that number by 12, that means you will be paying $948,000 on insurance annually. And when you consider the increase of 10.4% every year over the next 30 years, you would end up paying $186,686.23. So when you add these two numbers, you would have ended up paying $895,621.29. Now, I want to ask you to go back to this table right here because everything is going to take a very interesting twist from now on. And now we're going to work based on that $1,296,991.61. So we're going to use the exact same numbers. We're actually going to add them to the number that you see on the screen. Why? Because when you buy real estate to invest, property taxes and the cost of insurance, it's considered an expense that will get deducted from your business taxes. So once again, it will translate to more savings in your pocket, which in essence is going to increase your total savings. So when you sum all these three numbers, your total savings are going to be $2,192,612.90. What do you think about that? I'm telling you, taxes are a thing. They can either make you or break you. But if you understand the tax code and you know how to apply that to your investment, you can generate a lot more savings. And that's not the end of it. Let me share another twist. As of today, the average rent is sitting at $205,000 nationwide. Remember, this number is an average. So if you were to rent that property out for 12 months, the rental revenue that this property will be generating is $24,060. And since we're talking about future value, according to my research, rents increase at an average of 5% annually. And once again, remember, this is an average. Not all markets are the same. That's why it's called an average. So we take the ones that are not doing so good, the ones that are doing pretty good, and then we just combine them and get the average. So taking an average of a 5% increase over the next 30 years will mean that by the end of the 30 years, you will be generating a total of $1,702,504.60 in rental revenue. So if I were to take this number and deduct the cost of the house, which in essence were the interest that you were paying, you will be very surprised that in fact the cost cancels out and it's like your investment actually paid you to become a real estate investor. Your investment paid you $1,270,719.26 to become a real estate investor. And that's not even included the cost of renovations or repairs, which will typically increase the value of your home. And the cost of those renovations is actually tax deductible, which means more and more money back into your pockets. So back to the common share in the beginning, it doesn't matter what happens in the economy or whether you bought a house this year and then in the next year or two prices go down. It doesn't really matter because as you learn in the video, as long as you have a strategy and you know what you're doing, you will always end up making money with your real estate purchase. It's all about getting the right pieces of information and ignore whatever doesn't add value to you. What do you think about all the tips shared so far? And while I still have you here, I want to invite you to check out this video on the screen where I talk about how I was able to come up with the down payment for a $2 million purchase. Very creative tips, and I hope you enjoy it. I'll see you in the next video. Take care. Bye-bye.